Good evening, students. The today's module of accounting is structured to introduce the basic concepts of accounting right from identification of transaction to the preparation of the financial statements. The basic aim of preparing this module is to recapitalize all these things which are necessary for the paper of accounting for managers to interpret and analyze the financial statements. Basically, this module is prepared for the students of accounting for managers who are studying in M.Com Business Innovations. It is presumed that most of the students who has taken admission in M.Com Business Innovations has already passed BCom and has studied the accounting right from +1, +2 level to the graduation level. So therefore, it is not necessary that we should again study in detail right from identification of transaction to the preparation of the financial statements like profit and loss account and balance sheet in a detail. But the recapitalization is necessary so that we can move ahead. So therefore, this total accounting structure will be discussed in this lecture, and we will be moving right from identification of the transaction to the preparation of the financial statements till the end. So my dear friends and my dear students, today we'll be preparing the financial statements and recapitalizing for all postgraduate students from A to Z. So it is very much necessary to study all these things in detail. The key objectives of this module is number one, we have to understand the process of bookkeeping and accountancy in brief, right from identification of transaction to the preparation of the financial statement. Secondly, we will understand the double entry system of bookkeeping and the concept related to it. Similarly, we will be analyze the transaction and identify the two accounts which are involved in it. Fourthly, we will be understanding the recording in the books of original entry. What are the various rules to prepare the journal and subsidiary books? All will be discussed. Similarly, we'll be discussing the transferring the journal entries into the ledger and the process of preparing the trial balance. Similarly, the concept of closing revenue and expenses account, making correction and adjusting entries, and preparing the final account. So this will be the total structure of this module. And basically, this module will help the students of accounting for managers who are studying in the M.Com Business Innovation so that they can recapitulate the process of bookkeeping and accounting, double entry system of accounting, what kind of transactions are made in the business, and what kind of two types of accounts are involved in it, what are the rules for preparing the journal, what are the rules of accounting, what are the rules of recording in the books of original entry, and what are the various concepts which are related with the transferring the journal entry into the ledger, and what is the process of preparing the trial balance. And similarly, we'll be discussing the closing the revenue and expenses account. We'll be making certain adjusting entries which remains, or make some corrections which remains in the system of accounting apart from recording the transactions. So finally, we will prepare the final accounts on the basis of all this structure. So as far as the process of bookkeeping and accountancy is concerned, this process follows certain steps which are necessary to be followed. Number one, first of all, we define the transaction. When a transaction happens, we try to identify the transaction and write the transaction in the day book. And after that, we analyze the transaction and identify the nature of the accounts which are involved in it. And then we pass the journal entry in the book of original entry or in the subsidiary books. And then whatever the entries are made in the journal or subsidiary books, their corresponding entries in the ledger accounts are maintained. And when the whole process of preparation of the ledger account is complete, then we prepare and balance the different accounts which are maintained in the ledger and prepare a trial balance to check the arithmetical accuracy of the books of accounts. And on the basis of the list of the accounts which are reflected in the trial balance, we prepare the final accounts, that is the manufacturing, trading, profit and loss account, and balance sheet. So in this way, the whole structure of accounting is continued. So as far as the accounting equation is concerned, and because whenever we have to move, whenever we have to understand the basic structure of accounting equation is very, very important aspect which we must understand before moving forward. So as far as the accountants accounting equation is concerned, it involves assets is equal to liabilities and stakeholders equity. So as far as our business is concerned, in business, whatever assets are there, the investment in such assets are made by two kind of equities. One is loaned equity, that means the liabilities or the loans which we have taken from the outside parties like our creditors, but and second part is the amount invested by the owners, that is called the shareholders equity also, or in case of individual it is also called stakeholders equity or individual capital. So in financial accounting there are three concepts now. One is assets which are owned by either the creditors, or the investment is made by the owned equity or by maybe made by the loaned equity. So in financial accounting, an asset, as far as an asset is concerned, asset is a resource owned by the business or an economic activity. It is anything which may be tangible, it may be intangible, that can be owned or controlled to produce value. And that is held by an economic entity and that could produce positive economic value. Simply stated, assets represent value of ownership that can be converted into cash, although cash is also considered as an asset. And second part is these assets are owned by two kind of people. One is the outsiders who has invested in the business. They are our creditors. They may be in the form of the venture holder as far as the companies is concerned. It may be banks from where we have taken the loan. So in general, uh, outsiders equity are known as the liabilities, and in general a liability is an obligation between one party and another, not yet completed or paid for. In the world of accounting, a financial liability is also an obligation, but is more defined by the previous business transactions, events, sales, exchange of assets or services, or anything that would provide economic benefit at a later date. So liabilities are usually considered short term, expected to be concluded in 12 months, or long term that may be expected to be mature in more than 12 months. So put simply, so assets are owned by two kinds of personalities. One is, or the people, one is owned capital which is known as equity, and the loaned capital which are known as the liability. So as far as the equity is concerned, equity is the ownership of asset value which is owned by the owners. So created when the ownership contribute to the financing of the asset to purchase. So another way to finance the asset purchase is by the investment by the owners itself. So assets is equal to liabilities and the stakeholders equity. That is very important to understand, and the whole accounting structure revolve in it. And finally, in the form of balance sheet, we find out the assets, and second side we have the liabilities and stakeholders equity. So now in the total structure of accounting system, we have a very important term which needs to be understood in a very, very meaningful way or in a very simplified way. So in an accounting, account is very, very important concept. So account is a record in the general ledger that is used to sort and store transactions. For example, business will have a cash account in which the to record every transaction that increases or decreases the business's cash. Another account, maybe sales, will collect all the amount that from the sale of merchandise. Most accounting system require that every transaction will affect the twofold aspect, and it will have a twofold aspect, and that will affect two or more accounts. For example, when you make a cash sales, on the one hand the cash account is affected, on the other hand sales account which represent the goods, that is also affected. So on the one hand we have the increase in cash, on the another hand we have the increase in the sales account also. So these account the concept of account need to be understood very carefully, because the whole accounting system will revolve around this. So as far as the term account is concerned, there are various kinds of accounts which are represented in the form of accounting. One, there are two kinds of, broadly we can divide the accounts into two parts. One is personal account and second are impersonal account. So as far as the personal accounts are concerned, these are the accounts which are related with the name of the person or their rights thereof. They are known as personal account. For example, if you have purchased the goods from Ram on credit, and though Ram is a personal account because it represents some person. Similarly, when you have borrowed something from other person in the form of bills payable, so bills payable here represent that person. So these are the personal accounts. And second category of accounts are impersonal accounts, all those accounts which are not personal, which do not represent or any person or their names thereof, so they are impersonal accounts. So as far as the impersonal accounts are concerned, we can categorize them into two segments. Number one is real account. Real account represent the assets and their rights thereof. For example, you purchase a building, you purchase an equipment, you purchase a furniture, you purchase any other thing. So these are the real accounts which are represented. Second category of impersonal accounts are nominal accounts. All those accounts which are related to expenses, which are related to losses, which are related to all these things, these are termed as nominal accounts. So nominal accounts represent the expenses and losses which an organization incurs. So these are the two types of account: personal account and impersonal account. And in impersonal account, we have the real account and nominal account. So in categorization, we can say that we have three kinds of accounts. One is uh, personal account, second is real account, and third is nominal account. So as far as the rules of accounting are concerned, these accounts represent the various kinds of rules in both category of accounts, right? Personal account, real account, and nominal account. When we record the transaction in the book of original entry, we first follow certain rules of accounting. And for every kind of account, that is personal account, real account, and nominal account, we follow different accounts of the accounting kinds of the accounting rules. For example, on the one hand, we have the personal account. Now a person can either be a receiver or it can be a giver. So if a person is a receiver, debit the receiver. If a person is a giver, then credit the giver. And second category of accounts are real account. So real accounts, either the assets will come to you or either the assets will go from your organization. If you are receiving some assets, debit what comes in. If assets goes out of your organization, then credit what goes out. So debit what comes around in, and credit what goes account are the rules for the real account. Then third part of accounts are nominal accounts. So as far as the nominal accounts are concerned, we follow the rule: debit expenses and losses and credit all incomes and gains. Because nominal accounts are concerned expenses and losses and incomes and gains, so we follow the rule: debit all expenses and losses and credit all incomes and gains. So there are three rules of accounting: debit the rules and debit the receiver and credit the giver, that is represented in the personal account. Debit what comes in and credit what goes out, that is the rule of the real account. And debit all expenses and losses and credit all incomes and gain, that is the rule of the nominal account. So in accounting, we will follow the double entry system. So what is the double entry system? We presume that whenever a transaction is happened, every transaction will be having twofold aspect. It will affect the two accounts. So every transaction affects at least two accounts, and after each transaction, the balance sheet equation must always remain the same. We have already studied the balance sheet equation, that is assets is equal to liabilities plus stakeholders. So whenever a transaction will happen, it will affect the twofold aspect. Either it will affect the two assets, or either it will affect, on the one hand we have the assets, and on the other hand it will affect the liabilities and stakeholders. So it means every transaction, whatever will be happening, they will be balancing, they will always remain in balance. Our accounting equation will always remain in balance. So because in a accounting system every transaction has a twofold effect. On the one hand, debit side is affected, on the other hand credit side is affected, and it also affect the assets as well as the liabilities plus stakeholders, and the accounting equation will always remain in balance. That is also called, that's why it is called double entry system of accounting, because we record the both aspects of every transaction in the books of account. That's why it is called a double entry system of accounts. Next very important concept is ledger accounts. So the element of those transactions are organized into accounts that group similar items together. For example, we pass the various entries in the book of original entry, that is the journal. For example, some entries are related with cash, some entries are related with the sales, some entries are related with the purchases of the goods, some entries are related with the purchase of the fixed assets, some entries are related with different kinds of creditors, some entries are related with the different kinds of the debtors. So when all these transactions are recorded in the journals, they are transferred by ledger posting in different corresponding accounts and in a very organized manner, so that all kind of items which are related with one kind of account are grouped together. So in a double entry system, ledger contains the records of a group of related accounts. So a general ledger is the collection of accounts that accumulate the amounts of reported in the financial statement. So on the basis of summary of these different kinds of accounts and their balances, we will prepare the financial statements, that is trading, profit and loss account and balance sheet. So as far as term account is concerned, only one way we have said that this is an account, this is a account which represent a particular category of the transactions, and in ledger account different accounts are opened. Basically ledger account, an account is a T form statement, is a simplified version of the which is used in practice. Let's have a glimpse of it. You can see that on the screen you have different kinds of a T form statement of is made. For example, this cash account is there. So in cash account, we have two sides. One is left side, which is known as debit side, and another is right side, which is known as the credit side. So whenever there is an increase in the cash, that means cash comes in the business. That means debit what comes in. So left side will increase, and we will post the increase on the left side. And similarly, when the cash goes out from the organization, for example, you pay to somebody else, so it means cash goes out from the organization. So credit what goes out, so we will make entry in the form of decrease of cash on the right side. So the vertical line in the T divides the account into left side and the right side for recording increases and decreases. So the account title is on the horizontal type of account. So a basically account is a T form statement which has the two sides. One is left side and another is right side, and left side is represented debit side and right side is represented as the credit side. So let's see some examples. For example, we have the equation that assets is equal to liabilities plus stakeholders. So whether it is cash account, whenever there is an increase, whenever the cash comes in, we will record it on the debit side. Whenever the cash goes out, we will record it on the credit side. So similarly, for example, notes payable, which is a liability also, which represent our creditors also. So whenever there is an increase in the liability, for example, you have taken a loan of rupees 1 lakh from in the form of notes payable, issued the notes payable and taken a loan. So now cash comes in. So cash comes in because therefore this is an asset. So we will record it in the debit side of the cash. On the other side, notes payable becomes our liability. It represents some person. So we will record in the notes payable account on the credit side rupees 1 lakh. Similarly, when you purchase inventory, for example, so you purchase certain goods, we make an entry either purchases account or merchandise inventory account debit. So because it is debited because our inventory represent our assets also. So debit what comes in, so therefore entry will be on the debit side. So similarly, we will have corresponding entry. Suppose you introduce certain capital, so cash comes in. So it, for example, 4 lakh rupees has been introduced in the business. So the entry of 4 lakh, because cash comes in, so debit what comes in, so we'll make the entry on the debit side of the cash book, so cash account. For example, similarly, it increases our liability as well because it is owned capital which represent to the owner. So we will make because credit the giver is a basic our objective and basic rule. So giver will be credited here. The paid up capital represent the owner's capital account, so it will be on the credit side of the ledger account. So account is basically a T form statement which has two sides, left side and right side. That means debit side and credit side. So on the basis of the accounting rules, whatever journal entries has been made in the book of original entry, that is called the journal, we will correspondingly made entries in the T form, which is known as ledger account. So each transaction, so we have seen that each transaction affect at least two accounts. So the process of creating a new T account is called preparation. For recording a transaction is called opening account. So whenever and journal entry is made, and immediately when we correspondingly transfer them into the ledger accounts, if the account already exists, we will make entry into that. If the account do not exist, we will open an account, that is called opening of an account. So account balance, so similarly when the year comes to an end, on that day we will balance the debit and credit side of the account. And account balance is the difference between the total left side and the right side of the amounts at any particular time. So in this way, at the end, we will balance. For example, on the debit side of the cash account, we have 10,000. It means cash comes in 10,000 and cash goes out 6,000. So ultimately the balance will be 4,000 in our hand. So similarly, all accounts will be balanced at the end of the year. So assets accounts have a left side balances. For example, whenever assets are there, whatever assets are purchased, they will be always having a debit side balance. That is, entries on the left side increase asset account balances, so entries on the right side decrease them. So liabilities and owners equities have right side balances. Entries on the right side increase the balance, so entries on the left side decrease them. So in this way, we will be balancing the accounts at the end of the year, so that we can prepare the financial statements. Firstly, we'll prepare the trial balance. So there are two very important terms which we are using time and again. One is debits and another is credits. So accountants use these terms while preparing the financial statements or while preparing the books of accounts. So debits, which is abbreviated as a DR, to denote an entry on the left side of the account. And similarly, credit abbreviated CR to denote an entry on the right side of any account. Some accountants use the word charge instead of debit, but here in our Indian accounting system, we'll be using the term debit and credit instead of charge. So now next the concept is what is the process of recording the transaction. So we have 5 steps in recording and reporting transactions which we follow in accounting system. First is transactions documentation. So whenever a transaction happens, some vouchers are prepared, then their documentation is made in the day book. So day book is just a book in which simply the transaction is written that this transaction has happened. For example, when you start a business with 10,000, so it means the transaction will be started business with cash rupees 10,000. So this is just a writing of the transaction in the day book. And similarly, the vouchers files are also prepared whenever you have any kind of transaction. So when the transactions are written simultaneously from the transaction, we will pass journal entry. So that means we will prepare a journal. So most of the items which are not related to specifically particular area or for example cash or sales. They are directly recorded in the journal, but there are certain specified kind of journals which are known as subsidiary books. So some entries are recorded in the journal and some are directly recorded in the subsidiary books, so that we can have easiness while preparing the accounts. So whatever the entries are made in the journal or subsidiary books, then they are transferred, or their corresponding entries are made in the various accounts which are maintained in the ledger. So when all ledger transactions which are posted in the journal, their corresponding entries are made and ensured in the ledger accounts, then after that all ledger accounts are balanced, and their corresponding final tally is prepared, and that tally is prepared in the form of a trial balance. So for every kind of account which is opened in the ledger, we will have a balances, and such balances will be reflected in the trial balance, which will be a summary of all accounts which are maintained in the ledger. So trial balance will ensure the arithmetical accuracy of the books of account. It do not ensure that accounts are logically correct also. So if you have made certain kind of errors which affect the both sides of the account, then the one error will wipe out the effect of another error. So this way it will not affect the trial balance. So trial balance is just assured that there is an arithmetical accuracy. Arithmetically you are not wrong. And secondly, after preparing the trial balance, whatever the summary of accounts is available, on the basis of that and some additional information which may remain, which may not have been yet entered in the general ledger trial balance. So we have some additional information. On the basis of that, we prepare the financial statements. So the source documents are the original records of any transaction. I have used the term transaction documentation. The source documents are various vouchers which are prepared for having that transaction. So that is the source from where you can identify that this transaction has actually happened. So this is a recording process which we follow in the accounting. Now, the recording process in detail, the journal is formal chronological listing of each transaction and how it affects the balances in the accounts. Transactions are then entered into the ledger, then trial balance is prepared, and finally, we prepare the financial statements. So now the first step is, as far as the preparation of the day book is concerned, that is not having any kind of rules. Whenever chronologically on the date wise you have the various transactions, you just note down such transaction in the day book, so that after that you can start the process of journalizing the various transactions. So journalizing is the process of entering transaction into the journal. So a journal entry is an analysis of all the effects of the single transaction on various accounts, usually accompanied by the explanation, which is known as the narration. So sometime when business is started, some compound entry means a single transaction affect more than two accounts. So if it affects two accounts, that is simple journal entry. But if it affects more than two accounts, it means it's a compound entry which is made in the journal. So let us see journalizing, how to journalize the transaction and what kind of conventions we follow. So the following conventions are used for recording in the journal. So this is the performa of the journal, which is visible on the screen. So first we have the column of date. Second column is optional. You may have the entry number or you may not have. So you may record the transaction date wise, and along with, if you have given some voucher number or you have given some entry number, you may give that. So after that you have the particulars column. So sometimes people give the name as the particulars column, and sometimes it gives the accounts and explanation name. And then next column is post reference, or sometimes we usually write from the +1 and +2, we are giving the ledger folio column. That means this column will represent that at what page the entry of this transaction is made in the ledger accounts. Similarly, then you have the column of debit amount and credit amounts, which may be represented in the rupees or in the dollars. So for example, you have one transaction that started business with cash. Now here, first of all, this transaction will be analyzed, that how it affects the two accounts. On the one hand, it is affecting the real account. That means cash is coming in. and the rule is debit what comes in. And second is somebody, that means owner, is paying that money that represent the personal account. So here one rule will be debit what comes in, and second rule of personal account will be followed, credit the giver. So the entry will be cash account debit to capital account. So in narration you can write being started business with cash or capital stock issued to Smith. Smith is the owner. So in this way, for example, you raise loan from the notes payable. On the one hand, we have the cash account, which is a real account, and the rule is debit what comes in, so cash account will be debited. And the notes payable, which represent a creditor, that means a person, and he's a giver, so notes payable account will be credited. Similarly, you purchase inventory for cash. On the one hand, you have receiving one asset that is in the form of merchandising inventory, and on the other hand you are giving the cash. So debit what comes in, credit what goes out. So merchandise inventory will be debited and cash account will be credited. So similarly you will make a narration that being inventory purchased or acquired inventory for cash. So in this way, the title of the account or accounts to be debited are placed at the left margin, and the title of the accounts or accounts to be credited are intended in a consistent way. So the journal entry is followed by the narrative explanation of the transaction. So every journal entry you will write a narration, so that a person who is going to check the accounts or make the journal entry to ledger posting, he may understand, so what kind of entry is this. So similarly, the ledger folio column contains an identifying number that is assigned to each account and is used for cross-referencing to the ledger account. So at what page of ledger this transaction has been recorded, that will be reflected into that column. So this is a process of generalizing. Similarly, the debit and credit column for recording that may be in the form of rupees or it may be in the form of dollars that are debited or credited for each account, because every transaction is going to affect the two sides, that is debit side and credit side. So once this process of generalizing is over, then we will start the process of entering these journal entries, transferring these journal entries, posting these journal entries into the ledger. So posting is the transferring of amount from the journal to the appropriate account in the ledger. So the following examples is, for example, how to debit the merchandise inventory and cash are posted, and how column for the date, explanation, general references, amounts in the ledger are posted. This is an example for you. For example, let's take the third item, which is we have purchased the merchandising inventory and paid the cash. So it is going to affect the two accounts. One is merchandising inventory account and another is cash account. So here we will open two accounts, one cash account and another is merchandise account, entry account. So now the cash has gone, so entry will be on the credit side. So we will write by merchandising inventory 1,50,000. So similarly, on the other hand, you have purchased the merchandising entry, so asset has come in, so entry will be on the debit side. That means to cash 1,50,000. So in this way, the journal entry is transferred and posted to the various ledgers account. So similarly, when you have to post the cash account to paid up capital, that means cash is coming in on the debit side, we will write to paid up capital, that is 4 lakh. Similarly, on the capital account, we will write by cash rupees 4 lakh. So in this way, we will post all the journal entries into the ledger. So posting transactions to the ledger involve the cross-referencing, that is the process of using numbering, dating, and some other forms of identification. That means journal folio column will be there so that you can identify the entry which is made in the ledger account, at what page of the corresponding journal this entry has been made, so you can easily identify the journal entry. So single transaction from journal might be posted at different ledger accounts. So similarly, cross-referencing allow user to find all the components of the transaction in the ledger, no matter what they start. So similarly, we have different kinds of revenue and expense transactions which are there, which are related to our incomes or which are related to our expenses, which are related to our losses. So uh, because as far as our accounting equation is concerned, our accounting equation is assets is equal to liabilities plus paid up capital plus retained earnings. So assets, if there is an increase in assets, it will be debited plus, and if there is a decrease in asset, it will credit. Similarly, if there is an increase in the liabilities, the credit will increase, and if there is a decrease in the liability, debit will increase. So similarly, in case of paid up capital, if there is an increase in capital, credit side will increase, and if there is a decrease in capital, debit side will decrease. So similarly, retained earnings, which are the profits, which are, if there is an increase in the profit, the credit side will increase, and if there is a decrease in the profit, the debit side will increase. Similarly, the expenses and revenue accounts are maintained in the ledger. So revenue and expenses information is accumulated separately to have a more meaningful income statement. So expense and revenue accounts are a part of the retained earning. So although a debit entry increases expenses, it results in the decrease in the retained earnings. So you know all these because this is a recapitulation. For example, let us take an example of a transaction. Sale on credit rupees 1 lakh 60,000. Sale of credit rupees 1 lakh 60,000 means on the one hand your inventory, merchandise inventory has gone, but on the other hand your debtor is created, which is in the form of account receivables. So our account entry will be a person who is a receiver, because account receivable is a personal account, so debit the receiver, so account receivable account will be debited. On the other hand, we have made a sale, which is a decrease in our inventory. So though in profit we have sold it out, so we will open a sales account and sales account will be credited. So entry will be account receivable account debit to sales revenue account. So now therefore we will be opening two accounts, one account receivable account and another sales revenue account. So as far as account receivable account is, there it is, because it is debited on debit side, we will write to sales revenue 1 lakh 60,000, and on sales revenue credit side we will write by account receivable 1 lakh 60,000. So in this way revenue and expect transactions will be recorded. Similarly, for example, you have cost of merchandise sold rupees 1 lakh. So here the asset merchandise inventory has been decreased, same entry is there. So it is on cost of, it is sold on cost. So cost of goods sold debit to merchandise inventory, this entry we will be making. Similarly, there may be certain entries which are related to prepaid expenses and depreciation transaction. For example, you have made entry for transaction for prepaid rent for 3 months in advance, rupees 6,000. So now here the prepaid represented account represent to the person to whom it is paid, because it is not yet mature. So the entry will be prepaid rent account debit to cash. So on prepaid rent account we will make entry on the debit side to cash, and because the cash is decreased, so on the credit side of the cash we will write by prepaid rent account 6,000. So asset is decreased, therefore entry is made on the credit side. On the other hand, prepaid rent, which represent to the person for the time being, he is our debtors, so 6,000 will be on the debit side. So similarly, recognize the expiration of the rental services. That means rent expense of rupees 2,000 has been expired. The asset, now prepaid rent, which was already in the form of asset, now has decreased, and similarly this expense has arisen now because this rent has matured now. So the entry will be rent expense, because debit all expenses and losses, and prepaid rent, which was in the form of asset, has decreased to prepaid rent account. This entry will be made. So similarly, this will be converted into the different ledger account. So similarly, there are entries for depreciation. You have two options. One option is you decrease the asset, or another option is you create an accumulated depreciation account or provision for depreciation account. So whenever a depreciation is charged because it is an expense, so you may have an entry depreciation expense account debit to accumulated depreciation account, or you may have equipment account or asset account credited. So in this way we will make entry into the ledger also. So similarly, the book value or carrying value is the balance of account. That means at the end of the year, when your total has been made, all accounts will be balanced and their balances will be formed. And then we will move to the next category of the statement, which is trial balance. So trial balance is just a summary or list of all the accounts which, of the ledger balances which are maintained in the ledger. So the purpose of the trial balance is twofold. Number one, providing whether the total debits equal and total credits in the ledger, and it summarizes the balance in the ledger accounts in the preparation to construct the financial statement. So this is the performa of preparing the trial balance, which is laid down here. So this is one particular column, and debit column and credit column. So whatever the list of ledger accounts are there, that is listed in the particulars column, and if they have a debit balance, amount will be written in the debit side, debit column, and if they have a credit balance, then the amount will be written in the credit column. So at the end, they will match together because every transaction of both aspect has been recorded and their entries are made in the ledger accounts. And finally, if they are correct, our debit and credit balances will match, and which will ensure that it ensure the arithmetical accuracy of the books of account. It means that whatever the transaction were recorded in the journal, now their corresponding entry in the ledger has been made, and they have been properly balanced, and their summary is available and correct. So if they match, it is considered that. So the trial balance is prepared with the accounts in the following order. So assets account first, then liabilities accounts, then stockholders equity account, revenue account, and expenses account. So the trial balance is the springboard for preparing the balance sheet and the income statements. And once this is the format driving the financial statements from the trial balance. So this is the trial balance which format which has been given to you from here, because in the initial we have the assets given, they will be transferred to the balance sheet, and in the end you have the sales revenues, cost of goods sold, rent expenses, depreciation. These are all expenses and losses which will be transferred to the income statement. So from the trial balance, the finally we will be preparing the financial statement. So once the closing of the account has happened, trial balance has been prepared, it transfers the balances of the temporary stockholder equity account to the permanent stockholders equity account, and it makes the revenue and expenses account have a zero balance, which readies them for next period transaction. So at the end of the year, when we balance the revenue and expenses account, they will be treated as zero balance because it will be transferred to trading profit and loss account. So in the next year, we will be starting from afresh and will open the new accounts regarding this. So let's see, cost of goods account, goods sold is there. If cost of goods is having 1 lakh, its balance will be transferred to the trading account. Similarly, rent account is there, its balance will be transferred to the profit and loss account. Income is there, if it relates to profit and loss account, it will be transferred there. Sales account is transferred to the trading account. So similarly, depreciation account is transferred to profit and loss account. Retained earning, which is ultimately transferred to the balance, is transferred to the balance sheet. If it is an individual, it is added to the capital. If it is a loss, then it is deducted from the capital. So final accounts of this, when we have to prepare the final accounts, next step is the preparation of the final accounts of the sole trader. Then we have the 7 steps which we follow. First step, which we already discussed, we make a journal entry, then we make a ledger entry, then we prepare the trial balance. This is the steps which we follow in the bookkeeping. And after that, we prepare the manufacturing account if it is a manufacturing concern. If it is not manufacturing concern, then we prepare the trading account, profit and loss account, and balance sheet. So as far as the manufacturing account is concerned, it will reveal you the cost of production. If it is a trading account, it will reveal you the gross profit. And if it is a profit and loss account, it will be revealing you the net profit. And ultimately, the balance sheets will give a reflection of the assets and liabilities. That means our accounting equation will be represented. So this is the format of a manufacturing account. If your concern is manufacturing account, so this format we follow. So all these figures which are written here will be taken from the balance sheet or additional information. So here opening stock of work in progress is there, opening stock of raw material is there, purchase of raw material less purchase return, closing stock of raw material, all the expenses which are direct expenses like productive wages, manufacturing expenses, coal, fuel and energy, carriage inward, import duty, all are posted on the debit side of the manufacturing account. And similarly, if there are some returns, for example, you may sell scrap, work in progress, that will be on the credit side. And finally you will be able to make up what is the cost of production. So debit side will be more, credit side will be less, that will become by cost of production brought down. So cost of manufacturing you will be able to calculate. Similarly you have similarly factory overhead, factory lighting, all these expenses. And finally from the manufacturing accounts you will be able to then all the things which are related to yeah, which are related to it means the trading account will be happening, and cost of production will be carried down, then opening stock of finished goods, then sales will be recorded, closing stock of finished goods will be recorded, and you will be able to find out the uh, gross profit. So but if your concern is not manufacturing account, then you will simply preparing the trading account. So on the debit side you have the opening stock of finished goods, purchases, direct wages, direct expenses, all direct expenses like carriage inwards, duty and clearing charges, fuel and energy, octroi. So all this will be on the debit side. And on the credit side you have the sales, and naturally here the credit side will be whatever the credit side will be there, you will be credit side will be more. If there is a profit, gross profit, then on debit side you will write gross profit brought down. If you have a loss, by gross loss brought down, the figures will be there. So this is the format of trading account which we usually follow in plus one and plus two. So, and then whatever the gross profit or gross loss is there, that is reflected in the profit and loss account. And all indirect expenses like general and administrative expenses, bad debt, selling and distribution expenses, we will record on the debit side. Whatever the income in the form of gross profit, rent received, discount received, sale of scrap, all these will be there. If there is a profit, then to net profit brought down, and if there is a loss, to net loss brought down will be finally figure. So some organization prepare vertical form of the income statement that we prepare usually in the cost accounting also. Sales minus goods cost of goods sold, when we have a gross profit, less operating expenses will be having operating profit, less non-operating expenses will be having earning before interest and taxes, less interest, earning before tax, and then tax, and will be finally will be having earning after tax. So this is the format of income statement in the vertical format. So similarly we have the balance sheet. So in balance sheet, left side we have the liabilities, and the right side we have the assets. So basically these represent the accounting equation. So on the one hand we have assets, on the other hand we have liabilities, which may be owner's capital, or which may be outside equity. So on fixed asset, on the asset side we have fixed assets, investment, current assets, and similarly on the right side we have the capital, uh, in which the profit or loss is added or deducted, drawings are deducted, long term, then long term loan and current liability. So in this way the structure of balance sheet is available to us. So the mechanism which is involved in preparing these financial statements in final accounts from trial balances, a clear scrutiny of the format of the income statement and the balance sheet, which shows the following. So trial balance contains expenses, incomes, liabilities, and assets. So as far as the expenses and incomes are concerned, they goes to the income statement. So as far as the liabilities and assets are concerned, they goes to the balance sheet. So in this way, we follow the mechanism. So there are similarly, if you have a trial balance, some additional information may be there which may not have been yet reported or accounted in the journal or ledger. So it may contain certain additional information related to expenses, incomes, liabilities, and assets. So expenses and incomes as concerned, they will go to the income statement. But if the additional information is there, it will also affect income statement as well as the balance sheet. So similarly, when this additional information reflect to the liabilities and assets, it will go to the two aspects of the accounting equation, that is the balance sheet. So there are certain additional adjustments which we need to made. For example, If closing stock is there, usually it is not in the trial balance, so we will make the entry trading account debit to this closing stock. Or so it will have a two effect fold effect. On the one hand, it will go to the balance sheet in the form of current assets, and it will also go to the trading account, so it will having the twofold aspect may have been recorded. So similarly, if you have outstanding expenses, on the one hand it will go to the profit and loss account, and on the other hand, because still it is outstanding, it's a liability, it will go to the current liability side on the balance sheet. So similarly, you have a prepaid expenses, so profit and loss account will be credited, and balance sheet current assets will be shown. So outstanding or accrued income, so if it is an income, it will go to the credit side of profit and loss account, and in balance sheet it will shown in the current assets. So income received in advance, so if it is received in advance, so profit and loss account will be debited or either deducted from the concerned income from the credit side of the profit and loss account. So because it says income received in the advance, so it is a liability yet, so it will be shown in the current liability. Similarly, depreciation is there, so profit and loss account will be debited. On the one hand, it will affect the profit and loss account. On the other hand, it will be in the balance sheet, it will be deducted from the fixed assets. Similarly, bad debts are concerned. So bad debts are the losses. So profit and loss account will be deducted, and the other hand, balance sheet, the asset side debtors will be deducted. So similarly, provision for bad debts and other provision for discount on debtors are there. So if provision for bad debts is there, so it is debited to the profit and loss account, and on the other hand, you may write it on the liability side in the current liabilities. So provision for discount on debtors, profit and loss account will be debted, and on the other hand, and from the debtors the amount will be deducted. So provision for discount on credits, so profit and loss account here will be credited, and the balance sheet from the creditors we will deduct the amount from the creditors. Similarly, interest on capital is concerned, on the one hand we will debit it in the profit and loss account, and on the other hand in the liability side capital will be added with the interest on capital. Similarly, interest on drawing, profit and loss account will be credited, and on the other hand balance sheet capital will be deducted. So similarly, all these adjustments are made. So these are the adjusting entries which we pass for all these kind of transactions. I will be sending you all. So in this is the process of preparing the financial statements, right from preparing uh, entering writing in the day book, and then journals, then ledger, then trial balance, and then preparing the financial statement. This process is followed. So I hope this module will be just helpful to you to recapitulate. So this is not a complete explanation of all the things, this is not a practice of all the things, this is just to recapitulate all the things so that you can recapitulate it and move ahead for preparing the different kinds of financial analysis purpose statements, and go for ratio analysis. So it is advisable to you to just look into your all the books which you have already prepared, and after that you may go for detailed investigation and detailed analysis of the financial statement. So thank you very much. I hope this lecture or this module may be helpful to you to recapitulate it all the things which you have already studied. So we will be meeting in future also. So thank you so much.